Yes, we are live. And so, welcome, Chandresh. And before we start, I will request the audience. And first of all, thank you so much for joining in. People are still joining in. And we will also have this video on the YouTube later. And thank you so much for joining in. May I request all of you to please welcome Chandresh Nigam, big man today, big show, big expert talk today. And we will have a lot of questions to him. So please mention the city from which you have joined in. And please do welcome Chandresh Nigam, MD, CEO, Axis Mutual Fund.
Thanks a lot, Brajesh. Thank you very much. But really my pleasure. I really look forward to some of two interactions and talk about the industry, markets, etc. It's one of my passions. So thanks for giving me that opportunity. I should be
The
thanking
pleasure
you.
is all ours. And we keep doing these expert talks and where we want to scratch the mind of people like you to give us some perspective, as well as the MFDs who are joined in from all across the country. So Masterstroke has a very strong pedigree with 2,100 registered paid subscribers from 380 locations. And there's a lot of traction of the interviews that we do here. And so let's begin. And I can see so many cities, so you can see. So the best part about Masterstroke is that it is not located to one city, two city, 10. We have, audience from 380 locations. So we cover almost the length and breadth of India. So, okay. So Chandresh,
Wonderful.
I want to kick off by congratulating you that Axis is one of the mutual fund houses which has created a lot of wealth for Indian investors over the years. And there was for quite a long period of time, Axis Mutual Fund was topping the charts in terms of equity returns, and every scheme, every category, you were absolutely, giving fantastic performance. All of a sudden, in the last few quarters, performance is a little dull. And this is the first question which MFDs have in their mind. And so I want to kick off this question to ask you, any reasons and when do you think that performance will be back from Axis Mutual Fund?
Right. I think this needs a little bit of a long answer, so bear with me. When we started Axis Mutual Fund, we decided that we will invest in something what we call as sustainable businesses. Sustainable means that, see, I have seen so many businesses which come do well for a short period of time and then go away. You look at just the Bombay Stock Exchange, till in its history, BSE, I think, would have seen listing of maybe 10,000 companies. Today, I think the trading is happening in 2000. Value creation has probably happened in 400. So what happened to the 8,000? What happened to the other 9,600? Sometimes they would have done well, but now many of them are no longer. So nature of this business, nature of equities, or in fact, what is equity? Equity is basically reflecting underlying business conditions and how companies are exploiting them. I think it's pretty harsh for most companies. Not all companies really make the cut. So that was the first thing which I learned in my career. It's now 32 years I've been in this business. The first thing you have to ensure is that you don't have permanent capital loss. Things can keep going up, they can go down, stock market is there. But as long as point to point, I'm not saying 3 months, 6 months, but 3 years, 5 years, companies do well. If earnings are doubling in 3 years, 4 years, 5 years, then the stock should be somewhere there. Obviously, PE multiples don't remain the same. But the key is sustainability. So that was one thing, and that we decided and tried in 2009-10 that we will do things which are sustainable. What does sustainability mean? And I think there are two aspects to sustainability. One is the quality of the management and the vision and the execution, and that keeps changing, and good companies generally keep on getting better. And the other aspect is growth, because we just don't want a good company. We want this company to grow. Otherwise, how are we going to create wealth for ourselves? And then what we actually found was that there's a very high correlation on a long-term basis, 10 years, 15 years, 20 years, that these good companies are actually the ones which are growing. Some of them, other ones which are not so great. Sometimes we find that out post the event, but they do well 3 years, 5 years, and then they kind of disappear. So We said that we want to the best of our ability, we are going to be business investors. We are not going to be worried about short-term trends, because that is what, when we did the back testing, 30 years, 40 years data, is showing that these are the businesses, not only they survive, but they are the ones which thrive. And by all measures, and there is one important chart which I think many of your partners here, MFDs would have seen, because Axis has been using that same chart, updating the chart and using that for the last 12 years, 13 years of our existence, where it shows that the basket of companies which we define as quality and growth, they are the ones, actually the only ones which have created wealth. You knock them off, the market returns over the last 30 years will be virtually zero. And it's not something which is true for only India, it is true for the rest of the world as well. So coming back to your question, I think that perspective is important. We are not there to try and maximize return for investors. We are there to ensure that if an investor comes to us over a longish period, we generate reasonable amount of wealth for the investor when it comes to equities. How do you really ensure that? There's no guarantees in life, especially in equity market. But we have figured out that if there's a company which we can forecast is strong enough to be in business, its business model will remain robust, and if it can grow, let's say it can double, let's say worst case, 15%, that happens to be our cutoffs in terms of growth expectation over 5-year period, then mota you will also make, let's say 15% compounded by 5 years is basically doubling earnings. Then you should be somewhere there. It could be 60, it could be 80, it could be 120, it could be 150. But you will, so that is not just a wealth creation tool, but that is also a risk control tool for us. And we have, I can say very proudly, last 13 years stuck to this philosophy. Now, I'm not saying that there are no other ways of making money, but we think that this is one sure short way of making reasonable money. I'm not, as I said, we are not trying to maximize. If we can do better than the index over 5 years, 10 years, 2, 3, 4% with lower risk than the market, then I think that's the institutionalized approach. And you're right, I think from 2009, 10 till 2020, till the beginning of COVID, this was a fantastic strategy. I mean, nothing came close. I mean, it kind of surpassed even our own expectations.
Yes.
Now, one should understand what happens. That was an era where we were seeing narrowing of markets, lesser and less. There was a general slowdown. And there were these great companies which were at some point in time maybe not that well discovered. So we took advantage of both a valuation increase as well as growth. But that doesn't mean that 10 years from 2009, 10 to 2010, 20 was a straight line. In between, well, you cannot, this is not the only thing happening in the market. There are other things happening as well. So for example, in 2011, then in 2016 during demonetization, these portfolios did very badly. So while point to point 10 years, as you were saying, performance was great, but it does have its periods of underperformance. Now let's look at what happened after 2020. When demon happened, when COVID happened in 2020, I remember March 31st, I mean March 24th is when the lockdown started. Our stocks didn't fall that much during that period, and many of the others really, really fell. So when the bounce back happened, obviously our stocks did not perform. So last 3 years have been pretty, on a relative basis, a little frustrating for us. Strategy hasn't worked. Quality as a strategy has not worked anywhere in the world. So I'm not trying to hide behind that fact, but that's a fact one has to take. And then it's got complicated by 2 other things. So first it was the bounce, just the bounce. Then the fact that the narrowing of the market which was happening, because fewer companies doing well, more companies started to do well for 2 reasons: China +1 and PLI. I think these are the 2 things that fundamentally won't. So suddenly the universe which had contracted, suddenly we started to see good activity happening outside that. Some of these may be sustainable, some of these may not be sustainable. Some of these investments we also made in our funds. But we've generally stuck to our theme of long-term sustainability. Then Ukraine came in. I think we thought we will start to do well, quality will start to do well again. And then Ukraine crisis came in, and that was particularly bad for us. Nasdaq fell, which is in some way a proxy of growth. And then now you have the third element playing out, which is rise in interest rates. Now, as you can understand, growth stocks have large part of their valuations linked to future cash flows. And when you do apply discounting numbers and the discount goes up, obviously there's a much significant contraction. So that's what has happened. If I were to look at individual businesses, I think these are doing phenomenally well. One of the things I have learned is quality businesses actually surprise you on the upside generally. There will be some downturns, etc. But you look at a period, people, and that is why the returns have always been higher in the long run as compared to what analysts predict. That's because these companies, because they are visionaries, they do number of things, they execute, they continuously keep surprising the market on the upside. Now, if that is the case, do we want to give that up now and all? And we've had all this discussion because, as I said, 3 years has been a reasonably long period of underperformance. Where do we go from here? As I said, these companies are doing really very well. We have not seen, except for that COVID period where some of our businesses may have been under pressure. So businesses are doing great. The stock prices of all these are nearly at their highs. It's not as if that these stocks have the underperformance is because the stock prices have come off dramatically. Some cases it may not be there at the highs, it may be a little lower, but basically these companies have done well and stocks have done well. But because they didn't fall too much in 2020, the rise obviously cannot be that much. And two, the market has opportunity to invest in some new stocks. Question is, again, comes back, where do this? So we think 30 years, what has worked, eventually will work for the next 10 years as well, or the next 20 years as well. So we don't think that, but when it will exactly turn is anybody's guess, I think. But yes, what we see now, some of the difference in valuations, what we used to be there, let's say prior to COVID, rest of the market versus these, the premiums were very, very large. Yeah. I think with this correction, with the rest of the market bouncing back fast, maybe from lower lows, and these companies in some sense getting derated because while the profits are growing, the prices haven't kept pace in the last 2-3 years. The valuation gap has shrunk. It is still there. Growth and quality is still high, but it is, I think, in a situation where if today we were to deploy capital, you will feel a lot more comfortable deploying in high quality growth companies from a longer term perspective. So we think that we will, this style will certain to come back. I don't think you can have sustainable high growth happening in businesses or especially stock prices just because some new fad or new story has come in or something has happened. There has to be inherent strength in businesses. And so it's just a matter of time. I think the time is coming as the interest rates peak out and maybe go the other way, maybe this year, second half of this year, everybody is predicting that interest rates will come off. Growth numbers for our businesses continues to remain high. Some of the sectors will face problems. I would think the next year or so, I mean, while nobody can guarantee, but the difference in stock price performance for the rest of the market and us will converge, and hopefully it will go the other way, is what we do really, really believe. Whether it does better than all the other forms, we can't say, but looking at the market, looking at valuations, looking at the corrections in some of the stocks we've seen, because underlying these companies are gold. I mean, these are really, really very high quality businesses. So long answer, but it was important to just say that some people have said that why you are not changing portfolios and all that. I think it's important to understand our philosophy, our thinking. And as I said, this is not the only way of making money, but I think significant allocation to a long-term growth strategy, something which you can buy and hold. I think all of us have known people, relatives, my grandparents, etc., where you bought a good stock and you held it for 30, 40 years, and then what was virtually thought to be nothing has become some huge value. There are enough such cases. And my favorite example is Warren Buffett, actually. I mean, if you look at it, the last, 57, 58 years of the partnership which has been going on, Compounded rate of growth is about 18-19%. It's not as if that it has grown at 30% or 40% for that period of time. It's very difficult for anybody. Even that 18% is very difficult. If you can do that for a long period of time, and the key for him obviously has been you buy something good and you hold it. So I think in some sense that's what it is. That while the stock may have not done well, but the truth for us is the business. Is the business growing? Is the stuff happening? And if the business grows, stock prices will follow.
Great. So I have a message to the audience today. You know, you are working for so many AMCs. You are investing your clients' funds in so many schemes, and so it is very important for you to have such views, and then you take your informed decision which way you want to go, what AMCs you want to sell, and which schemes you want to sell. But these are the views that are very, very important for you to make an opinion about, you know, how stock market works, how companies work, and how the cycle runs. And so, Chandresh, I would like to have this follow-up question with you that India, it is a general consensus that India is not cheap and the valuations are expensive. On top of that, again, it's a general consensus, and you can clarify this. MFDs think that Axis has a growth strategy, and on top of it, the markets are expensive, and then you have a growth strategy that makes it even more expensive. Any comments on that?
So, Brijesh, I have heard this thing for the last now nearly 30 years. India is expensive. So if it is expensive and stays expensive, I think there is something that we are doing or our companies are doing very well that people still world over think that they are investment worthy. As you know, foreign investors probably own more of the Indian market as compared to Indian institutional investors, and I can add some part of retail investors as well. So what is it that does it? And I think the whole story is again quality. I think we are blessed as a country. We are blessed that we have these 300-400 great businesses, whether you can say Ferra dilution or whatever, where we had these high quality businesses with very strong governance and growth style of managing things in a risk controlled manner. And that's something which is percolated to many other businesses. So that's the entire IT companies. These were not foreign companies, but they were Indian companies, but they took the best practices. So I think from that perspective, you deserve a premium. The other is the India story itself. I think we are in that stage of growth where we will keep doubling nominal GDP 5-6 years, and so the opportunity is huge penetrate. So some part of it is already, and that's visible in all the consumer stocks, etc., that growth will be sustainable for a very long period of time. So I don't think, now you can always say how much of a premium is justified. That's a fair question, but I think India will continue to trade for higher multiples as compared to rest of the economies in Asia, certainly the world as well, for a long period of time. But then at the end of the day, the story is not about the market. The story is about the companies. And that's where, as I said, the companies are real gold and really, really well. And it's the same answer for Axis. I think when we are looking at our businesses, these are the ones which have actually driven the index, driven the valuation of the index for a long period of time. Now, I understand the concern of many of the people in the market, which is absolutely right. But how much of a premium should it be? There was a time, and one of my favorite examples is 2000. I don't remember 2004, 2005, after the dot-com bust in 2000, 2001, valuation started to go back up for IT companies. And some of these stocks, IT stocks, were quoting 200 times multiples and all those kinds of numbers were there. And obviously we figured out that yes, that's something which is irrational. Now that is obviously our job. Do we really think that the valuations we are paying are irrational? If COVID had not happened, what would have happened to our businesses? I think we would have been in a fantastic position, I can tell you. With COVID, some of these growth businesses saw a couple of years of degrowth, etc. Unfortunate, but that's something which happened. But now the call is again, what happens over the next 3-4 years? And I think and I'm not a fan, and I think I've gone on record saying that I don't, while we do look at PEs, I don't think PEs tell you anything. It certainly doesn't tell you about sustainability, and it doesn't tell you about the growth rates. So We are kind of comfortable from a 3 or 5 year view holding on to the stocks, which we think. So you are right, our Ps might be higher, but you will be very surprised if you do a comparison of many portfolios now, mutual fund portfolios, individual portfolios, or look at it stock wise. I think the gap is now 10-15%, and it's not really meaningful. So I would urge people to look more at quality sustainability, and the PE's expensiveness, the perception of the market that high PE is expensive, even that perception will reduce once you really see the numbers.
Great. So, Chandresh, you are sticking your neck out still in favor of growth companies, premium on India, and that's very bold call, and we appreciate it. You already answered part of this question, which I'm going to ask you now. But the question is, 3 years is a pretty long period of time, and you are acknowledging that things haven't worked out. During these 3 years, did you, as a company, think about changing your strategy? Have you done any kind of changes in the portfolio meaningfully? Are you looking at value, or only you are looking at growth? What has happened in the 3 years period? You must have done some,
as fund managers, Brijesh, you are every day is a new day. You have to keep testing your assumptions, your hypotheses every day. I mean, that's our job at the end of the day. We think a company is a growth company, but our interactions with the company, our interaction with its competitors and all that is always there to try and keep testing that, hey, is our hypothesis right or not? Because one thing I learned early in life, in my investing life, Rajesh, is if you are wrong on these growth companies, especially when it comes to their strength and sustainability, you can pretty much lose all your capital value. So that is something which we do every day. Now, I'll give you a statistic which will tell you what all we have done. I think it will summarize it very, very well. Going into COVID, let's say 2019, 2020, late 2019, if you were to look at the number of stocks we held in all our portfolios, large cap, mid cap, small cap, multi cap, flexi cap, whatever, that was 69 or so, let's say about 70. So 70 stocks was because the markets were narrowing. Opportunities of growth were not there. So we were invested as a fund in only 70 stocks as compared to maybe 200, 300, 400 for many of our peers. Obviously, in this period when the market has started to broaden, that list now has become about 170, 160 companies. So that tells you that, yes, it's not as if we are just buying something and holding on to it and that's it. We are cognizant of the fact that the Indian market has changed. COVID, though how unfortunate that event was, even though I think has been a boon to Indian industry, I think the corporate sector. It's given some, we've heard about the unorganized sector reducing in importance and everybody in the organized space really improving well. And they've got their growth rates now higher than what our hurdle rates would be. And there are a number of sectors, and I just talked about two of them, China Plus One and PLI, benefiting from these trends, etc. So we found those and we've invested in those. But at the same time, we've not lost the idea behind us. What is our strategy? Needs to be sustainable. We can be able to take a 5-year view on the business. There has to be some competitive advantage in the business. You don't want to just buy something, which is basically riding high because there is a wave. What happens if the wave goes off? And to be honest, while I know that our funds haven't done well, but you look at individual stocks which suddenly became very, very popular. And in the last 5, 6, 8 months, many of them are down 30, 40, 50%. So it's not as if that by going into value or perceived value or value which has now become growth, and that's another new thing which has come up, that I think at the end of the day, the touchstone is still sustainability. Valuation comes second. But yes, we are finding more opportunities. We have found more opportunities without compromising on our thinking that at the end of the day, don't get into anything which can lead to long-term capital loss.
Wonderful. So all of you, if you want to ask any question, please put that across in the Q&A box, and Chandresh and I will pick it up after a few more questions from my side. So Chandresh, again, the general consensus is that Axis is an equity fund house. Now, What's your view on the debt? How strong you are in debt, and what about your offerings? Because people relate Axis mutual fund that equity में पैसा देना है तो Axis को दे दो. Debt house में Axis बहुत strong नहीं है. Any observation and comment? And what's your
Yeah,
strength?
I think it has been a marketing disaster for us, to be honest. Yeah. If this comment was made, let's say prior to 2015-16, it would have been right, because at that time we were not that strong. Today, again, from a brand wise, we are not that strong. I know, I mean, that's the perception, and perception is reality. If people perceive Axis is not good in debt, then that's the brand perception on debt side. But the reality is very different, Vijesh. I think we have not popularized, or we not promoted our fixed income to the extent we should have. Maybe we were too busy on the equity side. But fixed income performance last 5-6 years has been absolutely fantastic. And I must say that it's actually an even stronger story than equity in some sense. Because one, you've controlled risk. You've not done anything stupid. You've not had large drawdowns, which probably I'm sure many of your participants here on the call know that has happened in some of the product. And it is par for the course. It's a kind of strategy. So we have used a similar strategy as equity. Don't lose money. You don't have to maximize return. And we are probably one of the only fund houses which runs across our equity or across our debts thing on the active side, active debts, where our performance numbers are there, right up there. I mean, I cannot talk of individual fund performance in this, but please go and check. Very rarely you will find a fund house which is outperforming across all categories. Yeah, and this is not short term. I mean, it's certainly true in the 6 months, 1 year category, but even in the long run. So this is, and the fixed income team under Shiva and Devang, they've done a fantastic job. I think we are trying to popularize and promote it. We did a marketing campaign on fixed income. We are reaching out, but by no means are we second to anybody in the fixed income space. Not just in terms of products, but also in terms of performance and thought leadership. I think the team is very, very clued on to economic trends, etc., and the kind of stuff which we do, internal analysis, etc. Obviously, we have made mistakes. Everybody makes in terms of calls, but more often than not, they have worked very, very well. And I urge you to just look at the numbers. And I think once people look at the numbers, look at some of the pieces which we have done in terms of our analysis, I think your view will change. That Axis certainly deserves not just equity allocations, but certainly fixed income allocations.
All right. So interest rates have cooled up a little bit from the top. GSEC from 760 odd is now 730 odd. As a fund house, what's your call on the interest rates? And as far as the MFDs are concerned, what is your thought they should allocate money to? Duration or low duration or ultra short term, which again is giving fantastic returns, expected to give very good returns in the future because of the high current short-term debt returns. Is there a meaningful arbitrage between a short-term debt fund, ultra short-term versus a medium-term GSEC or any duration product? What is your suggestions?
So right now, as you yourself articulated, I think the curve is reasonably flat. Yeah, 2 years and beyond, probably everything is within 30-40 basis points. So the question is, what is your risk appetite? So the first question is, and this is something which from a retail perspective sometimes is not relevant, because you can keep changing if you are an institutional investor or a very activity-oriented investor, take a change of call in 3 months. So generally, we do not like to recommend those kinds of strategies. So our point is more about building portfolios for the medium to long term. And should we be looking at duration? And our answer is yes. We don't know. You were said 760. Is that the peak? We think it could. We are not saying 100% we are sure. Looks like there will be some inflation data and all that will keep coming. But there's a good chance. I mean, we never want people to put money at one point in time. So you build next 6 months, I think, a debt portfolio. Now, what duration? We would then play the somewhere in between. You don't want to be only in the 1 year, 1.5 years, while the yield is good, but then there is not much meaningful capital appreciation possible. Over the next, I'm not saying capital appreciation will come in 3 months. It could very well be, but you may have to wait for a 1 year, 1.5 year period as well. So then you will not be able to capture. Should we go to the 10-year and 12-year and all that? It depends on the risk appetite. But I think the sweet spot is that 3-4 year kind of a thing, where you look at that, even a 2.5-3 year kind of a thing, where it makes sense for people to get some capital gain. You will get some reasonably high yields. And I don't think, again, like in equities, investors should kind of aim to maximize returns. You get reasonably good real returns, and I think you'll be happy with it. I think that's what the purpose of fixed income essentially is. Trying to get that 20-30 basis points higher and then taking undue risk is not what I will recommend.
So Chandresh, 20 years ago, if I correctly remember, GSEC touched sub 5%, 4.9 or 4.75 something. And after 20 years,
yes.
2004. And we thought that, we have arrived. And after 20 years, we are at 750, 2.5%, 3% upward. Do you think India is made for lower interest rates? And at what point of time one should be cautious? And because most of the time the yields are between 6 and 7.
Brilliant question. And I think, I hope I am wrong on this, but this is my firm view that India cannot have growth rates higher than 6.5%. As soon as it goes higher than that, you will see inflation coming. The supply side response, the infrastructure is just not there. So hopefully 3 years from now, I will change that view. But the fact is, absorptive capacity or demands, as soon as growth goes above 6%, puts enormous pressure and prices just start to go up. So absolutely right. I don't think anytime the rates are below this rate of 5.5%, 6%, you have to be cautious. You have to be cautious. There is no point. Can you hear me?
Yes.
Yeah. So I would always become very cautious as the rates go down. I will, rather than hunt for yield, and maybe the curve is also reasonably steep and you go longer and then you get hit like we have all got hit last 1 year. So our trend would be capture, elongate duration as the rates go up. It's the same thing as what you do in a SIP market goes down, you buy more. Here it is the rates, the prices go down, yields go up, you elongate, take more risk, and below 5.5 on the overnight, so which means maybe 6% on the 10-year, you become cautious. I think that should work at least the next 5 years.
So this should be a good takeaway for our audience to have this, while you can go aggressive at 758 kind of thing, you have to be very defensive at around 6 or sub 6 in terms of GSEC for 10 years. Okay. So a quick bite on international investing with some of the funds down by 25, 30, 35, and 40% in the tech space or the global consumer stuff. Is it a good time? And dollar doesn't seem to come down, and so you get a 40% lower valuation, and also the benefit of dollar. Do you think it makes a strong case to diversify internationally through mutual funds?
So Brijesh, 2 parts to the answer. One, what you have just mentioned is the short term. So short term, indices down 20-30%, 20% on the S&P probably mota moti, and Nasdaq 30-35%. Yeah, generally speaking, that's obviously great. But we are propagating exposure to international assets from a long-term opportunity come diversification perspective. So even if the market had not fallen 30% and say had fallen only 10 or was up 10, we would still urge people to build allocation internationally. And why are we saying that? As many of you would know, my life has been largely of that of an equity fund manager. So what I'm saying is actually counterintuitive. I've always said India is a great market for equities. Indian companies are great and they will grow. So why should anybody think of going abroad? What we are seeing is that new technologies, innovation, new ideas, I think have really, really exploded over the last 10, 15 years. So much so that despite our higher growth rates, we are finding companies which are even in low GDP growth environments are growing faster or as fast or faster than our really good quality companies. So that is one. So if wherever there is innovation, new stuff happening, and technology is really aiding the growth. So what in an earlier avatar growth would have been 10% is now 25% for some of these businesses, because technology allows them to reach out to different kinds of customers, markets much more quickly. So that is one. And second is diversification, currency, etc., etc. I mean, you are a global citizen now. You're consuming Chinese products, American brands, European brands, all that. Why should our investments be limited to just India? I'm not saying India is bad. India is a great place. I think as a market, we should do better. But there are businesses and companies out there which have the capacity to do better than an average portfolio. I'm not saying they will do better than each and every stock of yours. But when we are building portfolios, I think we can have global high quality businesses. We can have disruptive companies. And there are some pockets of innovation. I mean, while China has been a bad market, but I think we think there is significant amount of innovation happening there. Now, unfortunately, as of now, you know that many of the funds have suspended inflows, but I think that's a matter of time. I think people should keep their clients ready for investing globally. And especially if some of them feel that Indian markets are expensive, I think anyway it makes sense.
All right. A quick bite on active versus passive, and what's your strategy as a fund house? What do you think that MFDs should look into, active or passive? What any percentage you will suggest, or as an investor behavior, or the media propagating about this all active versus passive thing, and this kind of a fight that which will be, and the data doesn't support active in the last few years. So one should go for the last 5 years data, or there is still steam left for active funds?
I think this has been a tough time for actives. I think, and globally it has been proved out. So you must have a real reason to invest into the actives. And I think if it's a fund which is what is called as closet indexing, which is basically largely mimic the index and then have a small thing, then I think you are better off. And that's easy to analyze. I think matched portfolios, etc., it can be seen. Then you're better off on the active. I, for one, believe that even if you get 100, 150 basis points alpha on a long-term basis, I think it is significant. I mean, if you get into a fund and 10 years later, you get even 100, 150 points higher, it's a material difference in the final outcome, 20, 30% it could be. So I think there is a value to actives. Now, if you are unfortunately in a situation where not able to take a call and be convinced that this fund or this strategy is going to outperform, then I think it is better to be in passives. And I say this with a lot of humility. It's not an easy call. Just because the fund has done well last 2 years, it will continue to do well next 10 years. Unless I get too much information, I understand the strategy, it may be a difficult call to make. But the good thing is the passive, maybe it delivers less on a long-term basis as compared to a good active fund. But investors generally will not miss out on a lot. Yeah, I think unless it's about some small cap fund, etc., or something which is an outlier, which you can never really project. It is important to have investors in the asset class. And that itself will capture 70, 80, 90% of the benefits of the asset class. And if we can, you can find reason that, yes, I think we should be there in particular funds, etc., then we should certainly look at actives. I think the Indian active story has a long way to go. While everybody has kind of written it down saying it's going the global way, I think the Indian story is a little different. But it is different only for people who can think beyond the index. One of the things which we always believe is if you want to outperform the index, just forget about the index. Now, that's the only way. Otherwise, on the back of your mind, it's already there. In the last 6 months, I've underperformed. Let me get closer to some of the better performers in the index. And that never really works. So our answer is always passive plus active. It is not an either or. For some of the core positions, you will need large cap active positions. Some of the more tactical positions, you want index, etc., etc. I think it's better played, or a particular sector, etc., better played by a passive, because then you are also tuned and the investor is also tuned that this is more a short-term portfolio rebalancing kind of a thing, and that it will need intervention in the medium term, nothing is from a short-term perspective. So you can express your views in terms of what sectors to overweight, what parts of the market, what strategies to play, using some of these passives. And long term, whatever is core portfolio, even if you get that 100 basis points, as I said, it's better to be in the active rather than the passive.
All right. So, Chandresh, my next question is about size. And my question is that, does size matter? And before I have your opinion, there is an observation from the MFD community that when a fund house is small, they advocate that size does have an impact in returns, and smaller size funds have an advantage. And when they get more inflows and the performance is there on their side and they grow bigger, they change their view that performance size doesn't matter. With this thought in the background, do you have any observation about access?
Certainly, size certainly matters. I think people who say that size doesn't matter are not, I don't think they're being honest.
In terms of performance, negative performance.
In terms of, absolutely, in terms of performance, and I'll give you the reason why. And it depends on the strategy. Suppose you have a strategy which has been turning over portfolios twice a year, for example, and your size becomes big. Your impact cost goes away up from 25 basis points to 200 basis, which means anytime you want to buy or sell and move the portfolio, depending on what you are buying and selling, you will lose on the price action during the year by minimum of 200 basis points. It could go as high as 500 basis points if it's a small cap or a mid cap. I'm just giving rough numbers, don't hold me. Now, if you're doing it twice in a year, that means you are probably off 4%. Same fund, if it turns its portfolio once in 3 years, the impact is there, by the way. It's not as if it's not there. That 25 basis points is still 200, 300 basis points. But in 1 year, maybe the impact is only 1%. So certainly it has an impact. But if investing style is something which means that portfolios are held for longer periods, then the impact can be reduced. That's all I can. But yes, they certainly. We are all running active funds. I mean, the only way size does not matter is in passive funds, where you're just replicating and there is no real rebalancing which has to be done on over a period where you're buying, taking a call on some stock, selling it, buying something else. So certainly has an impact, but can be controlled by having a portfolio strategy which long term is aligned to buy and hold. Obviously, there is active management, so there will be some churn. But if the strategy requires you to continuously keep churning portfolios, then size will really, really underperform some of the smaller sized funds. Large sized funds will underperform.
So just on the sideline, I have an observation that probably in the last 1 year, some of the largest fund schemes have outperformed and some of the smallest fund schemes have outperformed. So there's no conclusive evidence that what works
So
the last 1 year.
Anyway, one variable to explain the entire difference in performance is not enough. So I'm saying all other things being constant, a large size fund, actively managed fund is at a disadvantage as compared to I won't say a small size, but let's say a medium size fund. Yes.
So I have 4 or 5 more questions, and then I will take a couple of more questions from the audience. And so we are running out of time, and we have around 10 minutes. So I want, I want to scratch your head into a couple of things. And before that, there is a concern in the market that some of the key employees, some of the key people have left Axis, and they have their own ideas. You want to make any observation, comment on this?
So actually, Axis at the senior level has had the least amount of turnover last 10, 12 years. So yeah, it is probably not true that we have high attrition. I think and overall also, I think as compared to the rest of the industry, we've had very, very low attrition. Now it is just so happens that a couple of our senior guys, not many, so 2 of our senior guys who've been at the helm and have really helped build this company, have decided to move out. One has moved out for better opportunity in the industry itself, and the other is moved out of the industry. I think it's kind of saying a bridge to ultimate retirement. So I think they've served the industry, served Axis really well long term. I don't think there's any other message which should be seen. And they are being, positions and all the activity which they were doing is being handled by others. So that's what it is. And some of the places where you really want really high continuity, especially in investment teams, etc., I think we have had virtually no turnover. Actually, if one looks at, and I think this may be some kind of a record, last 12 years, let's say the equity team, except for one person leaving to start his own business, we have not had any voluntary person leaving. Similar in fixed income, it's not such a great number. We've had a couple of people who left maybe 10 years ago and about 5-6 years ago. We've had virtually zero turnover. So I think from a continuity perspective, which is what investors should be worried about, I think there is nothing to worry about from them. So yes, we are not very happy that two of our senior people left, but we have to be sensitive to what their phase in life is and what they would want to do. We're all senior 50 plus kind of employees. They know that they have limited amount of time to do things, and yeah, so I mean that's the case of it. But it's got nothing to do with what's happening under performance or any of those kind of things. Yeah. These people have seen it all. They have gone through the previous periods of underperformance. I don't think they have worry that eventually we will ultimately certainly do well.
I'm sure. Any new initiative you would like to talk about at Axis Mutual Fund? Any new product, any new category?
Absolutely. Last 5 years, we've done 2 or 3 pivots. As you said, we started largely with equity, got into fixed income. In terms of business, I mean, products were there all through. We are a very strong votary of international. We are nearly using up our entire quota of outbound investments, of whether it is global disruption, large caps, quality, China, ESG related products. We've done a number of products for outbound, and we continue to do that. I think as soon as these limits are lifted, I think we have another 3 or 4 products lined up for launch. So that is one big thing where investors do need global diversification, and we should be able to provide it. Number 2 is passives. There was a time, as I said, I mean, being an equity manager and having generated alpha for good 22 years of my career, I always thought that why should investors look at passives? And I think that view has changed at the margin, certainly, that there is a place for passives as well. So that's the other thing. Now the challenge there is that we are a late starter, and how do we kind of innovate around to bring differentiated value? So that's something which we have been working on, and we'll do more. The third important area is alternates. And I know sometimes MFDs think that, hey, that is not my cup of tea. But I can tell you globally, the trend is at one side, there is passives coming. So if you look at the overall basket of funds, you are seeing a shrinkage. At one side, the passives are rising. On the other side, the alternates are rising. And there is something which is happening at the margin, which is allowing even smaller retail investors, I won't say very small, but mid-sized retail investors access the alternate space. So we have made a very strong commitment there. While we are not a very large AMC from a ranking perspective, I mean, we're reasonably large. But when we started on this thing about 5 years ago, we said we wanted a platform which has got the widest product slate, as well as individually each product slate we want to deepen up and have really good, strong teams. And we've invested a lot of time, effort in terms of people, money, etc., to set it up. So that is another of our initiatives. And then there are many other initiatives on digital, go-to-market, how to improve engagement with end investors, working with our MFD partners to see if we can get the interaction, something which you are anyway doing, Brijesh, and we did talk about earlier. We are also thinking how we can ultimately, as a industry, provide really good experiences to end investors, and that will be helpful for everyone.
So I have my final question, and then we will take some question from the audience. Chandresh, you have traveled the distance to become the managing director of a top mutual fund. How will you rate yourself as being a workaholic, and what's your hobbies, and how do you enjoy life? What are the things you would like to tell mutual fund distributors that, okay, money is one part, position is one part. What life has taught you as an individual to focus on?
I think one key learning I had very early, and that's kind of shaped my investment strategy as well, is sustainability. I think it's very easy to get caught up in fads, and then it ultimately ends badly. So I think that is the one thing which, and it's not just in investing. So investing, obviously, you learn that, but even otherwise in your career, in what you're doing, the work you're doing, etc., to really get meaningful scale or meaningful impact, I think you have to give it time. Yeah. And you have to give it time, you have to be in the right path, and you will need all the enablers, skill upgradation, etc., etc. Invest in yourself to be able to meaningful. And the great thing is that as a country, I think we have great opportunities. So it's not as if you have to be an investor only. I mean, there are multiple areas of opportunity. So it's all depends on you. So, and that gives you the whole thing about empowerment and ownership. But if you want, despite whatever challenges you may have in life, I think there are enough opportunities for you to make meaningful advances. So I think that's the critical one. In terms of hobbies, I think there was a time when my only hobby was investments, or I should say. But now I think there are lots of other things that keep me interested, I would say. And music is one. Trying to stay fit, though I may not look like it, but yes, I did spend enough time trying to work on myself and started running, etc. So yes, and then there are some more. Reading has always been there, and biggest is spending time with family.
All right. So one question I want to take from the audience is that when do you expect Axis Mutual Fund returns to bounce back? And the background is that Indian equity markets have been giving positive return in the last 3 calendar years. There's quite a possibility with the markets already running a high valuation, with American markets, may go into recession. That's the general perception kind of thing. With this background, do you think that this 2023 can be a negative year for the markets, or when do you expect Axis Mutual Fund schemes to turn around?
You're asking others, so.
No, I'm asking you.
Oh, you were asking. I thought you were asking the participants. Yeah,
No,
so I would think. See, my thought is very simple. I think the universe of stocks we own will grow at least 15% in earnings. Some of them will grow faster. I have no crystal ball to really say that the P will expand or grow. So we go with the assumption that it will be where it is. So I would think that we should get return somewhere in that line. I mean, it will not be a straight line, it will be ups and downs. Now, whether it will outperform the market or not, I can't say. But obviously, the fact that we are holding these the next 1-2 years, we expect at least that kind of return on the portfolio. So do I expect a positive return? Absolutely. I mean, and while people may keep talking about that this year is the year of China and all that, I mean, I've seen all these arguments. It may work for 2 months and then the thing will turn on a dime and say, okay, but India looks cheap as well. So it all depends. I mean, who would have thought that India would have outperformed the worst of times when everybody else was reeling? I think I actually take it, mean reversion never happens in quality businesses. They continuously, they may have ups and downs, but then the trend is one way only. So I think India will do reasonably well. I think India will do reasonably well, and we will certainly. Our stock companies do well, we will do well.
This question was from Pradeep Day and Mitesh Joshi. And for the last question, final question, any one advice you will like to give to mutual fund distributors to grow their business?
Engagement. I think I firmly believe, and you can look at all the businesses which have done very well over the last few years. And I can also talk about some of the new age businesses and not necessarily fintechs, etc. I'm talking of others, businesses. Their business has been done in a new manner. I think the reason why they are growing is because they have changed or brought in a new level of engagement or customer delight in their businesses. And it's not something which is static. And it is a mindset that I have to continuously keep improving the delight which I or the value which I give to my customer. And that's a real mindset shift. You're not just happy sitting on your laurels, sitting on the relationships and saying, okay, I've got good relationships. What more can we keep doing? And I think in our business, it's not about trying to forecast markets or anything. It's mostly about personalization, mostly about hand-holding when times are bad, etc. They do that well. I think that's got a lot more value, because how many times, if you plank is that I know where the market is going, then there will be times will go wrong. So that's not the plank I would build the business. I know people will ask that question and it has to be carefully answered, but I think getting them into the right assets, right asset allocation, hand-holding, and more importantly, personalization. I think that is key. And that's where I think MFDs have a fantastic future and opportunity. That you know your customers better than any other class of intermediaries in the market. I think it can really build on that. Just focus on the value to customers and word of mouth. And there are now various techniques to market as well. I think businesses are there to grow. But while in the industry, there are various companies, various sectors, various entrepreneurs whose wealth goes up and wealth goes down. But from an asset management perspective, I think the number only keeps going up. So I think we are in a great industry. We will have, if we have X number of people with 10 crores or 5 crores, it will obviously going to multiply over the next few years. So I think we don't have to be worried about demand. It's just that how much can we capture and what will allow us to capture it. So at one side, as I said, is effectiveness, which is quality of the value which you provide, and the other side is efficiencies, all the new tools, productivity, etc. And I think that's somewhere where, Brijesh, I think you are very well positioned. And we did have a discussion around how great value you can add to the industry. So I think all of us together, if we are on that path, at the end we will deliver customer value. I think all of us will grow. It's a mantra not just for MFD, it's for anybody associated with the industry.
Thank you so much, Chandresh, for this talk, and it was lovely to catch up with you in your office last week. And that's all we have today. And we wish Axis Mutual Fund and you all the very best in the year 2023. And we hope Axis will be back strongly, and we are all with you. Thank you so much.
Absolutely. Thank you very much for having me. I think I don't know whether you really planned it for more than an hour, but it was lovely there. I know maybe I've given some long-winded answers on some of these, but that is just out of my pattern.
Listen to you. Yeah. Thank you so much.
Thank you very much, and all the best to everyone, and Happy New Year. Have a great 2023. Bye-bye.